methodology that I use that talks at the beginning, those first couple of boxes, about a founder with a large vision for value creation, with really defined values. Increasingly today, we need to wind into that story a broader societal contribution and impact statement. That's getting increasingly important as the investment landscape changes. It goes a story that winds through, and you'll see the reference to a defensible moat opportunity, being ruthlessly driven by the impact they're having on customers and their agility, how they've got exceptional and attractive unit economics, and how they're ultimately in a clear path to scale profits and sustainability. These are some components of a story that in M&A is what makes deals happen. This, we could speak for hours about crafting this story. And it is, if you like, the other side of issues like valuation. Now, there is a whole bunch of technical methodologies in corporate finance. I'll touch on 4 of them right now. These are the kind of primary 4. We talk about things like a discounted cash flow, a DCF model, which is very commonly used in very stable growth and mature businesses, but really not that useful in early stage businesses where you've got high growth rates with high unpredictability. You've got 2 relative value measures. You've got comparable public companies. Of course, the beauty of public companies is that there's a whole wealth of information available to them. So we can tell you with great precision what multiple of last year's profit Google is trading on, by way of example. And we've also got a range of precedent transactions. As you've already seen, we had a list of notable transactions where you can look at how other similar companies have been sold previously. And then you have the cost approach, which is typically an internal approach. So if I'm the CEO of a company and I'm looking to acquire another company and I'm going through a build or buy scenario, I'm going to look at how much is it going to cost for us to do it ourselves. And that cost will include not just the straight tech cost of the CTO telling me I need a team of 20 people, I need 6 months to churn out an MVP and 12 months to have a mature tech stack in the market. There's also the opportunity cost. If we go back to that Microsoft example, Microsoft could not wait 2, 3, 4 years to have a really contemporary Outlook, iOS and Android app. So it's really opportunity cost, which is dramatically factored into those sorts of things. Summary here is really around the comps, as we call them, are the most commonly used assessment tools for tech M&A, but there is both art and science in carefully selecting and having the relevant comps. And it is, again, something that we see often, that people will go, well, Google trades on 40 times profit, therefore my small AI company is worth $50 million and we're 2 years old. Doesn't always work that way. And so careful selection of the appropriate comps is critical to getting that right. But when you do get it right, they provide a very useful market-based benchmark for relative value. I'm going to cut kind of to the chase here, and here's the last of my kind of 4 key points for you to take away. Because the burning question for all of you is going to be around how, for those of you that are potentially looking to sell your company, how do I get the maximum valuation? And my answer is, up to a certain point, it kind of doesn't matter everything that I've just said about all these valuation methods. The reality is, the key driver of valuation, number 1, is competitive tension. Having a range of people interested in buying your company. Second to that is the actual uniqueness and scarcity of your company, of the asset that you have. And third behind that is absolute growth rates and scale of the business. And so we can put up a pretty strong argument around comparables, but we will have to factor into that things like growth rates, the uniqueness of the asset, and ultimately if there is only one buyer at the table, that kind of puts the whole dimension of negotiation into a very different place. So, and I know we're kind of running out of time, so I will go a little faster. So in terms of how do you construct an M&A deal, so we've kind of already covered these two bits on the left side, which I'm not going to spend a lot of time on. So, you've got to have a strategy before you go and either buy or sell a company. If you're buying a company, the bit in the middle where you actually buy the company is important, but what you do with it after you've bought it is really the critical thing. So to speak, weddings are easy, marriage is hard. So the transaction execution will all go much better if you've got A and C well thought through first of all. And there's a series of steps you need to go through to construct a good transaction and execute it well. I will probably just focus on one issue on this particular slide because I want to get to some numbers with you, and that's the role of advisors. And if in any M&A transaction, you've usually got three types of advisors. You've got the guys in suits like myself, the corporate finance advisors, you've got the lawyers, and you've got the accountants. My critical advice to all of you is that relevant experience, understanding your sector, having done similar deals from all of these three categories is absolutely crucial. In the corporate advisory world, there are many types of advisors. There are generalist, big four corporate finance teams that do very good work. There are boutique specialist advisors, such as myself and many others like my firm, that focus just on one sector. And you need to interview a range of advisors to make sure that they understand your business and the market you operate in. In terms of lawyers, I have a whole network of lawyers that I work with right across Southeast Asia, and I recommend particular lawyers because of their expertise. That might be cross-border issues. It might be the fact that they've done a lot of M&A and they know a lot of the common issues when it comes to structuring of warranties and representations, whether it's how the legal terms that underpin and earn out are structured. Good lawyers, good advisors, and great tax advice, particularly where you're doing cross-border work, is critical. So let's get down to an example. And this is a fictitious company, but it's a pretty good one. So pretty simple cap table that I'll take you through in this example. And this is a company that's got a founder who has brought in friends and family and an angel investor that put in some money. They've brought in a VC, and that business is growing pretty well. The asterisk is something that is sometimes overlooked as a future consequence. Most VCs, when they invest in a company, will have a range of rights to do with preference shares that have control mechanisms, liquidation preferences, and there are important things that are part and parcel of venture capital investment. But they are often things that we find on the fundraising side that founders may not understand future implications. But it is part and parcel of venture investment. So our little company, you've got a very simplified set of metrics underneath. Revenue is growing really strongly. It's emerging from loss into profit, and the profit trajectory is really good. Its average customer value is strong. They've got low churn. Their customer lifetime value is really good. They've got great CAC metrics, etc. This is a great company. Why wouldn't you want to buy it? So an acquirer comes along and says, we love your company, we love what you're doing, we want you to come on board. We think that we can put $22 million in front of you, and that'll be made up of some initial consideration, and we want you to be part of the team, we want you to succeed, so we want to put in place a 2-year earn-out. So as the sums work out, they're going to get half up front, 11 million cash on closing. Then there's in this case, I've made it a relatively simple earn-out mechanism. The earn-out is in 2 payments based on the actual EBITDA achieved for the following 2 years. There's a formula. And so if you look at this and you look at that formula, you can see, okay, so they're buying 100% of the company and we're effectively getting 50% up front, and then we're getting a further 25% if we hit the numbers in the first earn-out and the last 25% in the second earn-out. And so if that all worked out, you achieved your earn-out, then the money is going to get divided up, perhaps something like this. This is where, and I work with a lot of venture capital funds, and I think they are great funds and a bunch of good people to work with. But this is an example where, at the end of the day, venture capital is about making money for the fund. And so in the upfront, the VC would get their liquidation preference paid out up front and then participate in the remaining proceeds that were available. There will be some of the advisors, etc., etc. So in terms of the upfront 11 million, that would be more or less how it would get divided up. Then you've got the earn-out payments. So if all went well, the final $22 million would be divided up that way. So that's just a very simple worked example, but even in its simplicity, you've got a whole range of issues. And this is where the negotiation is, to use the phrase, God is in the detail. Now, that type of earn-out, if you're very, very confident, is possibly a deal that you're going to go for, because it's a pretty decent chunk of money. But you would want to negotiate things in such as perhaps a floor, a minimum payment. The acquirer is potentially going to want to put in a cap so that they have a maximum liability. There's going to be a whole range of issues that go into the term sheet that gets produced. And so it fundamentally is never going to be as simple as what I've put on the screen there. But if you are a founder selling your company and you've got the right set of terms and conditions that protect for their risks and you as the seller for your risks, that might well be a great deal that you can proceed with. So let's go through a couple of scenarios now to give you a sense of the kind of questions I get from founders on a day-to-day basis. Again, I won't go through all the detail here. So the first one is a subscale, growing tech company. And when I say subscale, that is not a disparaging comment. That's not a negative. It's just a reflection of it is not a company that is very large at this point in time. So a smallish but growing tech company, and they get some unexpected inbound interest from a potential acquirer. This happens semi-regularly, and I get calls from founders in this situation. And it's all about how well do you know them? Are they serious? Will they pay a good price? How fast can they move? That's on their side. And then on your side, are you actually prepared? Are you in the optimal situation to negotiate a great deal? And the key issue in this type of scenario is one buyer, one seller, no competitive tension. So the pathway to success is an interesting one. So the first thing is you've really got to qualify. Is that potential buyer, are they serious? Why do they want to buy my company? What is their commitment and their timeline? The critical thing that you've got to be able to do is buy time to get ready. If this is the deal that you think potentially you can do, you need to scramble and get ready. And there's high risk in that. And many times in this situation, a deal will never happen. It's also sometimes a trigger for consideration if there should be a broader process that the founder should embark on. And there's a tension there between, well, I've got this one buyer. Can I go and really quickly see if there are a bunch of other buyers that I could bring to the table? And that generally doesn't work. If you've got somebody that's inbound, that they're keen, you're not generally going to be able to hold them off for the 3 to 6 months to implement a proper strategy. And so there's a kind of difficult situation in that. But in my view, often those types of inbound single buyer don't succeed from the point of view that you won't get anywhere near the maximum value that you might otherwise have achieved in a proper process. Second scenario is kind of the reverse of that. So this is a growing, funded, perhaps at scale tech company, identifies a smaller company that they know really well and who could bring a clear piece of the puzzle. And so the issues here around how well do you know them, in particular, how well do you know their tech, their product, the team, the customers. Where this situation often works very well is where you have two companies that, so it may be this situation where you've got a collaboration, they've got a piece of code or some sort of API, you've implemented it through just a straight commercial partnership, you've worked with them for a year, you've got to know them very well, you know what their tech is like. If that's a scenario that you've been through, then that's actually acquire a company. But of course, you still have the pathway of, do you as an acquirer have a focused strategy? Is everybody within your company, your board, your shareholders, your management, is everybody on the same page with that? And do you really understand what the synergies are and how the people and the culture will be implemented? But if you've had this scenario and you've got somebody you've been working with and you really have some insight into their business, that can be a very good scenario to move into acquisition. The third one is more of the mature company where you've got strong growth, the founders, the board, the shareholders are all in broad alignment that it's time to understand market demand for a trade sale. And so there's the issues that I commonly come across in this scenario is one, working through, are there a set of that would want to buy your company? And then thinking laterally, who are the non-obvious targets? And you'll see that in an example from a war story I'll give you very shortly. Are you prepared to go to market? Have you pulled together the story, etc.? And one of the critical issues becomes, once you engage in this process, even with great corporate advisors that are managing most of the external work, it still is, up to a point, a distraction for the CEO and founder. And how you manage that is really important. How you share with the team or don't share, or what you share about going to market. The business still runs smoothly while you're engaged in the process. Becomes really important. Path to success, work with good advisors who understand the business, prepare your team to the process. And probably my key issue here, which again I'll bring to life in a war story in a moment, is really resisting getting fixated on a particular number. I'll come back to that. And just to give you some sense, I said I'd share with you details. So this is a live M&A is currently managing. Cannot tell you anything at all about the company, but just to give you a sense of what it's like. So this through the process with the board of identifying who would be the obvious buyers as well as the non-obvious. Our raw list was